Good morning and welcome to the winter edition of our economic outlooks, our global economic outlook, our UK outlook, and our outlook for UK region and households. Unfortunately, Stephen Millard can't be with us at the moment, so I'm Barry Naisbitt, and I'm going to talk about the outlook for the global economy, and then after about 10 or so minutes, I'll hand over to Ben to talk about the outlook for the UK economy, and Arnab then to talk about the UK regions and households. So I won't cover Stephen's initial remarks, but I'll start straight off with looking at the outlook for the global economy. And I think it's the first point I'd like to make really is about our production of the global economic outlook. It's very much a team effort. The team members' names are on the list there. I'm only acting as the presenter of it really here today. And we produced the outlook using our global economic model, NIGEM, which is essentially, I suppose, a large interrelated country macroeconomic model, very important for trade variables in there. And if people want to find out more about the model, there's more information on our website. If you'd like to subscribe and use the model yourselves, then please do contact us, and we'll be only too happy to help you to become new subscribers and new users of our NIGEM model. So that's how we do it bit out of the way. What's our global view? Well, essentially, inflation has fallen in particularly the advanced economies. We see the advanced economies as being the main area where higher inflation has been an evident economic problem in the past few years. And because it's fallen, market discussion, economists' chat has all moved to talking about monetary easing. Interest rates have increased significantly, and now it's the focus of interest is when will interest rates start to come down? We argue that the timing of that will depend upon core inflation, perhaps even more than it might depend upon headline inflation numbers. In terms of global economic activity, the global economy has been resilient. There have been recessions in a few countries, but relatively limited. And we expect that to continue, that resilience to continue, I should say. Geopolitical events will be a key for the 2024 outlook. I'll talk about those later on in the risks section rather than the main forecasts. And this is very much a year of elections. Elections not just in the UK and US, but in very many other countries, as we see on the screen, Pakistan today or yesterday. And on balance, we feel there's little room for positive fiscal policy action in this year of elections, if only because the level of debt has risen, public sector debt has risen significantly, and interest rates are higher and providing a higher cost of servicing that debt. So if I move on to just some descriptions of those via a few charts that appear in our global economic outlook, you can see from the left-hand side that inflation in the major advanced economies peaked in 2022 and has come down steadily since. However, when one looks at core inflation, I would draw your attention to the scale of the two charts. The first one goes from -2 to 10. The second one goes from -2 to 8. Core inflation has not risen as much as headline inflation, but also has not fallen back as much as headline inflation. And we think that's very much the key to thinking about where monetary policy will go from now on. Core inflation remains stickier than headline. Moving on from there, what does that mean for monetary policy tightening? Well, our view is that monetary policy tightening has now stopped in the major advanced economies. I mean, it's been quite a while now, almost 6 months since interest rates were last increased in any of these economies. And we think that the outlook is for rates to start to decrease gradually. we've got our assumption or our forecast that the easing cycle will start in the middle of this year. But that's very much conditional on what core inflation does. And we do see core inflation falling, but only gradually. Hence, we have what you might think of as a relatively gradual fall in policy interest rates over the next couple of years. In terms of what's happening in economic activity, most of the impetus to growth is coming from the service sectors. The left-hand side chart shows the recent PMIs in services. You'll notice a bit of a pickup at the start of 2023 that coincided with the what I might call the reopening of the Chinese economy following the COVID closures. And in terms of industrial production, the bottom line is advanced economies. You can see there basically industrial production flatlining in advanced economies, but industrial production still growing in the emerging economies. And what we're expecting, in a sense, in our forecast is the service activity to keep picking up a little bit and industrial production to remain, broadly speaking, where it is in advanced economies. If I move on to our global view in terms of the headline numbers, we estimate global growth last year of 3.1%. We're expecting, or forecasting, I should say, it to fall to 2.8% this year and then pick up a little bit to 3%. In truth, there's very little difference between those numbers, but it's sort of resilient global growth, and we're not really expecting recessions in economies to start to hit. If we look at where the growth is coming from, in 2024, we expect to see slower growth in the US than we did last year, and also slower growth in China, and also slower growth in Japan. They're the main contributors to the slowdown in growth that we're expecting. We've made little change to our GDP growth forecast, as you can see from the bottom part of the chart, the left-hand side. In terms of prices, we look at a sort of an OECD mix, not quite the same definitions the OECD use, I should say. And we're looking at inflation falling to this year and then falling next year as well. Let me put a bit more meat on those bones with some other charts. So our typical fan chart showing the probabilities of various outlooks on the left-hand side. You can see that the black line running through it is our central forecast, our baseline forecast, and there's we believe a downside bias or downside risk to dominate that. In terms of the right-hand side chart, what we've looked at here is the number of countries we cover individually within our Niger models, about 47, and we've looked at which of those are seeing higher growth this year than last year and which are seeing low growth. It turns out that in our forecast, most of the countries, about two-thirds, will grow faster this year than last year. However, the bigger countries, the US, China, Japan, will see slower growth, and that produces the overall slowdown in growth. But if you look at when we move to 2025, then the number of countries experiencing faster growth increases further. If we move on to emerging economies, they're continuing to lead the global economy. We think that the GDP contribution of advanced economies has been slowing, unfavorable demographics, climate adaptation in some of them, and trade fragmentation. And we've talked a lot about that in the past. For emerging economies, we think that some of them will be reaching the limits of globalization and closer to productivity frontiers than they were, and hence growth will start to slow a little bit more. We're already seeing that in China if you look at growth in, say, the last 5-10 years compared to the previous 5-10 years. Moving on to look at inflation, we see an upside risk to OECD inflation. Lower commodity prices and tighter policies will help to give us lower inflation in the advanced economies, you can see on the right-hand side there, with inflation coming towards 2. later this year and into 2025. But geopolitical tensions and the possibility of oil prices, energy prices rebounding give us that upside risk, we believe. So finally, onto the risks. Well, one can only put some on the slide, obviously, but the first one is the ongoing war in Ukraine. Then there's the possibility of wider conflict in the Middle East, which is clearly something that is starting to cause concern in international transport markets, where we're starting to see prices of shipping transportation rise, and uncertainty about whether ships will indeed go through the Suez Canal, or whether they'll move their operations to go south of South Africa. We've got widespread elections around the globe. Some of these issues we've covered in one of the boxes. We have 3 boxes in our global economic outlook. Some of these we're talking about these geopolitical risks and the elections and the conflicts. Another box talks about the possibility of a house price correction in the US, which again one would expect to be negative for US growth. Inflation may be stickier than we think, or than we're predicting, and we might see a sharper slowdown in China, given that we're already seeing news of deflation in the Chinese economy, which, while positive for global inflation, may well turn out to be negative for global activity. That there's much more to be seen on that, I imagine. So let me finally just quickly summarize with our key messages. Inflation's fallen in advanced economies. We expect monetary policy easing, but that depends on core inflation. Global economic activity has been resilient, but it still looks weak. And we think geopolitical events will be key to the 2024 outlook. That's really all I'd like to outline on our global economic outlook. But I'd really like next to hand over to my colleague, Ben Caswell, and Ben will present on the UK economic outlook. Just like to say thank you for listening, and thank you for subscribing, and enjoy the rest of our presentation. Thank you.
All right, thanks for that, Barry. Barry, if you can hear me, give me a thumbs up, just to make sure we're all on the same page. Hopefully the audio is fine here. If it's not, just let me know in the chat. Right, okay, so is it all good? Yeah, perfect. Thanks, yep. Barry. Thanks very much. So if we could just go on to the next slide, please. Thank you. So good morning, everybody. This is our key messages from the UK Outlook. So as we all know, the Bank of England has done its job and inflation is falling. As base effects drop out of the headline measure and wholesale energy prices have continued to fall, inflation has come down much more quickly than we anticipated relative to 1 quarter ago. So naturally, this raises the question, when will the Bank of England start to cut rates? Well, while the headline rate of inflation has fallen substantially, core inflation remains stubborn and wage growth is still elevated. So this means that inflation is very persistent. As a result, we do not expect any rate cuts immediately, but instead we expect the bank to start cutting rates in May, sometime in the middle of this year. This is also consistent with the interest rate paths implied by market expectations. This does give the Bank of England a bit of breathing space should any of the upside risks stemming from geopolitical uncertainty materialize and feed through into higher prices. So in the context of a year of relatively poor economic growth in 2023, no doubt these rate cuts will be quite welcome. Now, on the topic of our forecasts for output, we do believe that the UK just dipped into a technical recession in the second half of 2023. However, it should be stressed that this is a technical recession and it doesn't materially alter the economic conditions of the ground. You can really think of it as just flatlining growth. There has been really no growth in the last 2 quarters. So for 2024 and beyond, we do expect growth to pick up a little bit, and we expect it to achieve a kind of trend rate growth in the long run of 2024 and 2025 and beyond of around 1%. But this isn't due to any sort of negative output gap. It's just a lower trend rate of growth, which we expect the UK economy to be on in the long run. So turning to headline inflation, we now believe that the stage has largely been set and that significant falls in the headline rate of inflation are likely to continue into the first half of 2024. We project there is going to be a fall to 3.7% in the first quarter and 1.2% in the second quarter. This puts inflation in the middle of 2024, just below the Bank of England's target. And then towards the end of 2024, we'll have some rebound effects and inflation should be at the Bank of England's target by the end of 2024. It's also estimated that the energy price cap, which is going to come into effect in April, is going to put downward pressure on energy prices, some 14%. And this is driving some of the additional falls in the headline rate of inflation, which we see in the second quarter of this year. This undershoot gives the Bank of England room to cut rates a bit more cautiously, and it also provides a buffer for the bank to lean on if any of the geopolitical uncertainty materializes and then feeds through into higher energy prices and food prices stemming from shipping costs and oil price shocks. Now let's take a look at our interest rate paths implied. So given the observed falls in the headline rate of inflation, we now anticipate that rates will come down much more quickly than we thought relative to 1 quarter ago, as shown here by our dashed line. So the dashed black line, or the dotted black line, is our path from the previous outlook. We now think that the interest rate is going to come down much more quickly, and we're going to arrive at this long run interest rate of around 3.25%. We think that's where the interest rate is going to settle around the first quarter of 2026 now. However, because inflation is persistent, we expect the bank to hit its target rate of inflation much sooner than the interest rate settling at its equilibrium point. So as we can be seen, markets have adjusted their expectations, and the market path implied by the red dashed line is broadly in line with our estimate here. However, in comparison to the Federal Reserve or the European Central Bank, the Bank of England has been a bit less communicative with regards to rate cuts. Now, this is an open question, obviously, but given that there has been an environment of tight monetary policy, communicating rate cuts can help markets price in more efficiently changes in rates. And at the moment, the market expectations, they have been essentially not had as much information to work on vis-a-vis the announcements from the Federal Reserve. So turning to GDP growth now. The black line here is our central forecast, of course, and as you can see, we've got a fairly wide fan here. We now believe that because of the environment of tight monetary policy and persistent inflation, this has filtered through to dampening economic activity in the last 2 quarters. Now here, just to sort of clarify, this is annual GDP growth at the quarterly frequency. Now, because we project a technical recession in the second half of 2023, this line doesn't actually go below 0. So what that means in practice is that this was such a sort of small, insignificant contraction that it wasn't large enough to bring the annual figure below 0. So again, if you look at this here, it's essentially flatlining growth at the moment. So this technical recession should be understood as such and not a meaningful contraction in output. So moving forward to future growth prospects, they still remain relatively sluggish. However, in 2024 and 2025, we expect around 0.9% in 2024 and then 1.2% in 2025. Beyond this, we don't expect any meaningful uptick in the growth rate, and we expect it to have a trend rate of around 1% growth. And this sort of underpins underlying fundamentals related to low productivity and also post-pandemic scarring of the labor market, which we will turn to now. To just sort of dive into the labor market figures a little bit more, we can see a detailed picture here. So the figure 1.7 on the left, the gray line here is representing real wage increases. And we can see that over the past year, workers have attempted to restore some of their real earnings back to pre-pandemic levels. However, this has not filtered through to a wage price spiral. Instead, firms have managed to absorb some of these real wage increases due to the elevated profit margins they've experienced over the last year, and particularly the early part of 2023, which we can see in figure 1.15 here. So the spike in the profit share here is representing the corporate profit income. You can think of this as sort of the share of the economic pie that firms are retaining in capital earnings here. And over the past 2 quarters, you can see that this has come back down quite rapidly as firms have essentially had their margins eroded and workers are sort of bargaining back some of their real earnings. Now, if we look at our forecast projected, we expect further declines in this corporate profit income share, and it's going to return to its long-run equilibrium level, which is around 31%. So essentially, we expect it to be back where it was at the end of 2024. And at this point, the margins for absorbing further wage increases have been significantly eroded and fairly exhausted. So this does pose a little bit of an upside risk to inflation because there will be some wage growth which is driven mechanically this year because of the implementation of the national living wage in April. There's an increase from around £10 to £11. And this is going to put compression on the bottom of the wage distribution, and it's going to narrow differentials, and it's going to put upward pressure. However, given that firms have exhausted most of their margins, whether some of those filter through is yet to be seen. Okay, so also a little bit more detail on the labor market here. We're going to turn to the second slide regarding labor market tightness. So as a result of this, we can see that the unemployment rate is rising gently, and we expect it to be around 4.7% by the end of the year. Looking to 2025 and beyond, we expect the unemployment rate to settle down at its equilibrium value of U star, which is around 5%. Moreover, if we take a look at the labor market tightness, we can see that the vacancy to unemployment ratio has come right back down, and it's actually in line with pre-pandemic levels. However, this isn't to say that we're returning to the same labor market as we were before the pandemic. Economic activity remains elevated, and average hours worked remains depressed relative to 2019 figures. This constitutes a persistent labor supply shock, both at the intensive and extensive margin. So while on the surface, some of these indicators may look like we're returning to the labor market of norm pre-pandemic, recruitment difficulties have eased, but if you dig a little bit under, there are still underlying fundamental concerns there. And there's also an ongoing conversation regarding the quality of labor market statistics, given the suspension of the labor force survey by the ONS. And we also have a box on this, box B, which takes a more detailed look at this matter. So turning to fiscal policy, we see that the benefits to public finance from above target inflation are still percolating through the system, albeit at a much lower rate than they were previously. So there's been an increased tax base because of fiscal drag, and there's also been downward pressure on real wages in the public sector due to above target inflation. As a result, we have started to see net borrowing to GDP, the deficit, falling slightly. So as inflation dissipates this year, going forward in 2024, fiscal choices are going to become much tougher. In the fiscal year 24-25, we expect the deficit to GDP ratio to remain relatively high at 4.8%. But as tax boundaries are still frozen, there's going to be some fiscal drag, and this is going to essentially raise a bit more revenue, and a primary surplus is expected to emerge in financial year 25-26. And beyond this point, it's going to keep a downward pressure on the deficit to GDP ratio, which we see gently falling through the forecast horizon here. However, these fiscal plans for most of this period are going to be set by the winner of the next general election, as we have an election this year. So nominally, this allows the Chancellor to meet the fiscal framework rules. However, whether these constraints on fiscal choice in 2025 and beyond bind in practice is another matter. So on to the second part of fiscal policy. Looking at the OBR's projections going forward and the government's plans as of now, the government spending can be somewhat front-loaded. So for the fiscal year 24-25, there is a forecasted uptick in public investment. So at NISA, we're obviously very happy about this, and we welcome any proposed increase in public investment, as it puts us much more on par with comparable OECD economies such as Germany, France, and Japan. This 4% puts us much closer in line to our neighbors, and similar economies. However, the benefits of public investment will only accrue if this higher level of public investment, in line with comparable OECD economies, is sustained over the long run. As we have our forecast here, you do have it tailing off a little bit. So as it's an election year, we recommend any remaining fiscal space that the Chancellor has is directed to sustaining that higher level of public investment rather than diverting it to any pre-election tax giveaways. But beyond this, we also urge that in the medium run and the longer run, we would like to see some reform of the fiscal framework. And we would like it to be able to integrate some long-term economic objectives for the UK and remove the broken incentive structure which arises from this singular focus on these 5-year rolling targets, and perhaps also an inclusion of other metrics beyond the debt to GDP ratio, such as public sector net worth. So returning to our key messages, I will leave you with these headline points of ours. So headline inflation falling faster than expected, Bank of England going to start cutting rates in the middle of this year, the UK dipped into a technical recession, and growth to remain sluggish around 1% in the medium run. So I'll leave you with those key messages, and thank you very much. And now we will turn to Arnab for the outlook on the devolved nation and English regions and UK households. Thank you very much, everybody.
Thank you, Ben, and thank you, Barry, before that. And thank you, everyone, for joining us on the Economic Forum Winter 2024 presentation. So as Ben said, I'm going to take you through the our projections for the devolved nations, English regions, and UK households. This is very much joint work as ever. A fantastic team assembled here at the National Institute to do this work. So here's our overall picture. But before going there, let me give you a bit of a background setting. So inflation is falling back to target. Particularly because of tight monetary policy. So monetary policy has done its job or doing its job. Wages are rising. They have risen quite a bit last year. The wage rise is tapering off now, but still there will be moderate wage rises next year. So that is positive as well. So there's an election sometime. We don't know exactly when, but it will come potentially sometime towards the end of the year. And because of the election, there are battlegrounds drawn up across the country. And again, there are potentially interesting benefits that can come out of that process. Most importantly, of course, the allocation of leveling of funds. Ben has talked about public investment, so that go in that direction. And Stormont coming back into action. So there are some positives there. However, the more long-term backdrop is that there is slow recovery of living standards, particularly of low-income households, in fact, of even middle-income households going all the way up to the median household. There are uneven patterns of leveling up. And the emerging big problem also on which we have a box here is the financial problems that local authorities are facing. Some of them have filed for bankruptcy and more may be on the way. So we suggest that the Chancellor, if they have the opportunity, perhaps take this opportunity to support local authorities and to raise public involvement, maintain public investment at 4% of GDP, to try and get the finances in order. If they are not able to do that, then maybe council taxes will rise again, and that is also a very regressive tax. So over to the key messages for UK households. Slow recovery from distributional shocks. So the COVID shock and the period after Brexit, so on and so forth, had huge hits, put on huge hits on household finances. So for households in almost up to the median, income decals 1 to 4, living standards, here measured by real disposable household income after tax, net of taxes, and net of housing costs, will be between 7 and 20% lower in 24-25 relative to 2019-20. So that is a large fall. In fact, for the poorest 10%, in the bottom decile. The fall in real income since 2019-20 is about 4,500, 4,600 in current prices terms, so in current pounds. So where does that leave us? So here's a distributional picture of where we stand. So next year we are expecting a moderate increase in household incomes of about 2%, 1.9% in the circle there. Where does this come from? Well, a little bit of that comes from increase in wages. Also, there are higher savings and more interest income earned on the savings because interest rates are staying high for some households, but there are distributional consequences of this. But even with this 2%, it only takes about a quarter of the shortfall in real household incomes since the start of the pandemic. For the squeeze middle, living standards are projected to rise by about 2% on average, still below pre-pandemic levels. At the bottom end, the situation is quite much worse, so about 20% fall overall. And the current increase is taking up about 2% of that. Now, how far has tight monetary policy helped? So living standards of people in income deciles 2 to 5 will not return to pre-pandemic levels until the end of 2027, and that is, as Ben said, partly as a result of lower longer-term trend growth in the economy and lower productivity. So the scarring effects of cumulative shocks are continuing despite policy interventions, particularly at the bottom of the distribution. Loose monetary policy would have made it worse. So we do some analysis of counterfactual outcomes across the distribution in the chapter. Please have a look at that if you're interested. But rather than the tight monetary policy, if we had a loose monetary policy, the situation would have been much worse. Moving on then, so here's a graphic showing how these, the effects, the tax rate effects compare with the fall in real incomes. And we can see that the tax rates and freezing of thresholds, the effect of the two, and the lowering of national insurance contributions, the three effects together, they are relatively small relative to the overall fall in household incomes since the COVID crisis. But also that these effects are regressive. So tax effects have not helped the poor. Moving on, so how much is the fall in real income as a result of, since the COVID crisis? Well, as I mentioned earlier, if real incomes would have risen at the same rate and costs would have been similar to pre-pandemic levels, household incomes would be about 4,500 pounds more in the bottom decile. But you can see all the way up to the fourth decile, there would be substantially higher household incomes. In terms of the regional distributions then, there are uneven patterns of leveling up. We tried to look at the impact. Previously, we have tried to look at the impact of the rise in minimum wage and national living wage, and we found that the impacts were largely on the second decile of households across the income distribution. Why is that so? Because these households are poor working households, right? In the bottom decile, there are more households on benefits. So we looked at the weekly earnings for these, at the 10th percentile across the regions of Britain. So the 10th percentile overall weekly earnings rose by 7.2%, but there is some significant regional variation, which we can see next on the map. So 8.5% growth on average across the distribution relative to 21-22 in 22-23, but 17.1% increase in the Northeast. Okay, so that is, we think, because there's a larger concentration of low wage workers in the Northeast. So Northern Ireland, East of England, East Midlands, Southwest experienced increase of less than 6.5% in comparison. So that's one level of leveling up, or one way to look at leveling up in the very short run, not in the medium to long run. What else do we see? We see that the geographic pattern of leveling up, allocation of leveling up funds is interesting. Well, one thing to mention here is that because Stormont was not operational, so there was no allocation to Northern Ireland, but across English and Welsh and Scottish regions, there was allocation. In the third round, there was a larger concentration, here shown on the map, there was a larger concentration in the northwestern Scotland, but otherwise more evenly spread. In round 2, which was around 2.1 billion outlay. So that was largely concentrated on the Northwest, and 1 billion, so 1.7 billion in round 1 went to Northwest and Scotland, 1 billion in the current round. Round 3 went to Scotland, Wales, Yorkshire, and the Humber. So it's sort of spread out, but it is sort of going to more poorer regions of the country. And so, you know, in some ways, this is emphasizing the battlegrounds, election battlegrounds being drawn up. So ONS has revised downward UK-wide estimates of employment. This has negligible distributional impact across the regions. However, what this means is that pre-existing differences and disparities persist. Low economic growth for all developed nations and English regions. So most regions would have returned by now to their pre-COVID levels of gross value added, right? Not much increase over all those levels. The Midlands will still take a bit more time to revert there. So this will not be until 2025. And that is particularly because of the hit to manufacturing and trading in the Midlands during the COVID period and beyond. So this is shown on the charts on the following slides as well. Right. So here, in terms of regional and developed nations gross value added, and the same picture, so it's a flatlining picture, which Ben also highlighted earlier, but with a little bit of a growth. But in terms of employment, on the next slide, you can see that this is really flatlining. And that flatlining, of course, also means that regions which were behind, had already fallen behind earlier, they stay behind. For example, Wales here, and also the Midlands. So the concluding thoughts are that lower income households require real wage growth, and that can come only through creation of good, green, and globally tradable activities and the skills which go with it. But in the very short run, what can the Chancellor do? Potentially higher thresholds, right, would be progressive rather than regressive, rather than an income tax cut. There is urgent policy action in the direction of funds for local authorities at threat of bankruptcy, and enhancing house building activities, which also go in line with public investments. Medium to long term, there is need to reform the council tax system, and some discourse regarding that is already happening. And we need productivity enhancing public investment. So that is our overall message. Thank you very much.
Thank you very much, Shana, and Barry and Ben, for some excellent presentations. I should apologise to the audience that I wasn't there right at the beginning of the of today's event. Unfortunately, I had a couple of glitches with my computer, but I'm here now and happy to open the floor up to questions. Now, people have been writing questions in the chat, so I'm going to call upon people to ask their questions. But I note that almost every question I'm looking at is for Ben. So in order that poor Ben doesn't get the whole of the brunt of questions, then please think of some good questions to ask Barry and Arnab. I'm going to start first off with João Faria. João, do you want to unmute yourself and ask your question? Because I think I've looked up the answer for you.
Hi, can you guys hear me?
Yeah, we can. Thank you.
Oh, lovely. Thank you for this. Just wanted to ask if you could please elaborate a bit more on your CPI forecasts, because you have CPI at 1.5% in April, and that is fairly below the Bank of England's forecast. They have 2.1%. So I was wondering if this bigger deceleration relative to where inflation is today is mainly for energy-related reasons, or is there also an element of core inflation coming in, you think maybe lower than the Bank of England is predicting? And how big of a step down April would be relative to March? I mean, is there a big deceleration between those 2 months? Or in other words, is the gap that you have from relative to the BOE's forecast something that already starts to show up from January, from February, March, or is it mainly a story of April? Hope that was clear. Thanks.
That was clear. And the answer is it's entirely a story about April. So the Bank of England have 3.1 in March. We have 3.1 in March. But we see a fall in April to 1.5. And the reasoning behind that is the following, that there was a big increase in inflation of 1.2% in April of last year. That will drop out. So other things equal, inflation would drop by 1.2% just because of that. In addition, we have used information from Cornwall Insights to suggest that the household energy price cap will be cut by 14% in April. That, in and of itself, will knock another 0.7 percentage points off inflation. So we've already got a drop of 1.9 percentage points in inflation. We think there's obviously going to be some new inflation coming in. That's going to reduce that drop. But we still wind up with an overall fall of about 1.5 percentage points in April. Now, we think that's actually what we would expect just through base effects. So the fact that the Bank of England is not as low as us suggests that possibly that they expect a lot more inflation to come in, or they haven't as yet taken account of the possible fall in the energy price cap. I suspect it's probably the latter. And that's the difference between us and the bank for April. But very much it's a big fall in April for those two reasons. Great. We're going to go back to Katerina Lysenkova. Katerina, do you want to, we'll try and unmute you so you can ask your question. This one will be for Barry.
Hello, can you hear me?
We can indeed.
Great, thank you. There was a mention that one of the reasons that the global growth contribution by advanced economies is declining is climate. You didn't say climate transition, you said
climate mitigation, I think.
Yeah, well, it was something else. It was something else. But I was interested if there was any analysis done on the past, on things that already happened. I know about the NISA contribution to the NGFS scenarios, but if you have looked at the trends that have already happened, so UK, let's say UK mitigation policy, or US or EU mitigation policy, what contribution did it have to the economic growth in those regions? Thank you. Thanks,
Katerina. Barry, do you have any thoughts on that?
Well, I mean, just to say that the word we use on the slide was adaptation, which is just as good as any other word, I suppose, in this context. I mean, in brief, the one word answer to Katerina would be no. We haven't done any work on this. The longer answer would be, if someone's prepared to fund us to do some research on this, we would love to do it, given the amount of research we've already done on climate-related issues for the NGFS work. But we haven't done any work on that at all. I suppose my gut reaction would be, other than saying I don't know, would be obviously to say, well, there's going to be some negative parts where activities get disrupted because productive capacity is moving around from A to B. But there's also going to be some positive parts because of the growth of the new sort of green energy industries, you know, wind farms and the building of all these things. And what the balance of that is, I don't feel terribly well qualified to judge. So I don't really want to speculate on that. But obviously, Katerina, if you or anyone else out there listening wants to provide us with some funds to do some research, we'd love to have a go.
Thanks, Barry. Yeah, if you have any money, Katerina, we would very much welcome it. I think is the message there. Okay, we're going to go for another global question, actually. Nell Agate Tsui. I hope I've pronounced that right. Nell, are you there? No. Maybe we'll come back to that one then. I got a couple of questioners for Ben. Let's take these together. So Martin Temple first off. If someone can unmute Martin so he can ask his questions.
Good morning. Can you hear me?
Oh, we can, Martin. Yeah, you're a bit blurry, but we'll see what we can do. Go ahead.
Yes, there's a couple of questions. I think one builds on the earlier question around your forecast for UK inflation. So I think as well as the Bank of England having that coming down in the short term, they were then expecting that to increase over the longer term. So for the rest of 2024, they had it ticking back up. I don't think your forecast does, so I'd be interested in what drives that difference. And then I also think Ben referenced the increase in the national living wage. Just interested in how inflationary or not that might be.
Thanks, Martin. So the two questions were on the national living wage. Is that going to be inflationary? And do we have the same tick up in inflation as the Bank of England towards the end of the year? Before, Ben, I'll let you answer those. Let's have a question from Francisco Sebastian, who actually wrote one of the boxes that was in our Outlook that's just come out. So Francisco, hopefully someone will unmute you and you can ask your question.
Good morning. Thank you. Good morning, everyone. My question is about the basis for the uptake in GDP growth. My intuition is that the decline in the deflator will play a big role, but I was wondering if you could then please provide a little bit more information about views on nominal growth and what are the sectors contributing the most. I suspect public investment will be an important driver, but maybe if you can either confirm or refute these intuitions, I would highly appreciate it, please. Thank you.
Okay, thanks, Francisco. Ben, over to you.
Okay, thank you for both of you for those questions. The first one, it was a little bit difficult to hear the audio, but I think I got it. So it was, why does your forecast sort of fall below target and then pick up at the end of the year? And then the other one was about the national living wage and how that might filter through to upward pressure on prices. I think that's correct. So yeah. The first one, well, it kind of overlaps a little bit with Stephen's first answer, which is that there are simply quite a lot of base effects dropping out. And that's why we get this sort of downward sort of, they're quite significant effects as well, which is why we see this sort of downward trend. And then we do see towards the end of this year, as potentially energy prices might tick up a little bit through geopolitical upside risk. Also, we've got this national living wage coming through, so we might see a little bit of upward pressure towards the end of the year. But largely, this is driven by base effects. It's mostly a mechanical exercise at this point. With regards to the national living wage, it's going up quite significantly as a percentage. It's about 10%. So this does put serious compression on the bottom of the wage distribution and with lower differentials. So there has been talk at our business conditions forum that there are obviously some concerns about these lower differentials and how it might impact employers, given that the margins are just not there to absorb these wage increases like there were in the previous year. So it does pose a significant risk, I think, to sort of creating somewhat of a wage inflationary spiral. But I don't think we should sort of get ahead of ourselves. We should very much see how these things pan out. But it's definitely something worth considering, given that firms simply just don't have the capacity to absorb those kind of rises as they did in the previous year. And with regards to Francisco's question, so which sectors are driving the growth? So we have quite a large part of the growth being driven by this uptick in the proposal for public investment. So obviously we're taking the OBR's numbers and we're taking what the government is projecting forward for the next 5 years. That is quite a big driver. Also, again, this is sort of supplementing business investment, which is not growing massively, but we still do have the full expensing accounting. And hopefully we expect this to sort of filter through this year and provide somewhat of an uptick. But I don't know if you want to say anything on this in terms of deflators or sectors that you were mentioning, Stephen.
No, I think the deflator is going to play a role, because what we do is we take the OBR's forecasts for public investment in nominal space and then deflate them given our forecast for inflation. So the fact that the GDP deflator is coming down quite a bit raises real public investment, which then does contribute to real GDP growth. So thanks for that. Next question. We've got a couple really for Arnab here. The first is from Ying Jin. If someone can unmute Ying Jin, that would be good.
Hi, you can hear me?
We can.
Yeah. Okay. So thank you very much. And this is a question, although it's sort of directed at Ben, but I would like thoughts actually from the whole panel, if possible, because the quality of jobs actually have now changed very much. Headcounts actually mean much less than before. The number of working hours per person is much more difficult to do, and my guess is that probably has reduced per week. And I just wondered actually whether you have done anything in the forecast, and also your thoughts on how to handle this going forward, given that employment data now is actually much more fuzzy than before.
Okay, interesting question. I was giving it to Arnab because I think Arnab's probably got stuff to say on the quality of jobs and the part-time, full-time split. Ben, I don't know if you want to come in on the point about average working hours, which I know is something we tackled in the Outlook.
Yeah, so I mean, average working hours is obviously the labour market data has been difficult, obviously, since the suspension of the LFS. But there were some preliminary estimates released actually earlier this week. And if you take a look at them, the average weekly hours, they are still below pre-pandemic levels, even though they're a slight revision upwards based on some of the previous figures. But in terms of the quality of jobs, I'm not sure exactly what that refers to per se. Is that sort of compensation? Is that compensation per hour worked? But in terms of full-time and part-time status, there are definitely more proprietors, more self-employed people. There are which tend to earn less than employees. There are also more part-time workers relative to full-time workers as well. You can think of it as this sort of split emerging, and the full-time equivalent employees are essentially, they're not as high as they were, right? Because you've got these more part-time workers. So in terms of average hours, again, it's just indicative of a sort of an intensive labor supply shock in the labor market, because those hours have been compressed. We might have the same number of workers, but they're just choosing to work fewer hours. Also, we have a lot of people dropping out of the labour force due to ill health as well. So economic inactivity is slightly elevated still. And in the UK generally as well, we have more people taking early retirement and leaving the labour force vis-a-vis comparable European economies. So all of this puts sort of supply restrictions on the labour market. Hopefully that answers some of your question. Also, we have Box B as well. Obviously, I implore everybody to read Box B, which sort of tackles this issue of labour market data in more detail.
Thanks, Ben. Arnab, I know you and your team have done some work on labour markets around the country, and I don't know if you've got some thoughts on the quality of jobs and how our standard measures of headcount of employment might not be the right thing to think about in terms of labour markets. Arnab, any thoughts?
Yeah. Yes, so well, this is a point well taken, Miss, and well made, actually. So, without looking very carefully at ours, it is very difficult to understand which kind of jobs are earning the higher returns and so on. The issue about rise in minimum wages and national living wage is that these are really relevant to very poor working households who are doing some of the most low skilled jobs in the economy, and okay, so there's a little bit of wage increase there, but that is not really taking us anywhere towards improving the nature of the jobs that people do. Means, of course, if there are wages coming from the jobs, the quality of the jobs, the kind of jobs that people do, that there needs to be much more action there. So, creating the opportunity for people to do good, green, globally tradable jobs is what we should be aspiring to do. I think there is very little activity there. The leveling of funds can potentially help in this direction, and there is some allocation going along these lines, but their impact will come in slowly. So that is a space that we want to watch for the future, but at the moment we do not see sufficient good jobs at the lower end of the distribution at all.
Thank you, Arnab. I mean, that answer kind of segues quite neatly into a couple of questions that I see in front of me, which may well be the last two, but we'll see. I've got someone called Lewis here. If we can unmute Lewis first off to ask his question, then Dimitri Korpakis, if we can unmute him, we'll take those two questions, I think both aimed at Arnab, and then we may well have to call it a day at that point. But anyway, Lewis, if you're unmuted, can you go ahead and ask your question, please?
Hi, Stephen. Yes, I think I am unmuted. I'm asking this from a trade union perspective. You've said lower household incomes require real wage growth, and you've shown that graphically. But you've also said corporate profit income share has already absorbed high wage growth. So my question is, what do you think will give?
It's a good question. While I let Arnab think about that, Dimitri, hopefully you're unmuted and you can go ahead and ask your question as well.
Yeah, thank you very much. So my question goes to Arnab. It's in terms of leveling up, you suggest productivity enhancing public investment, which of course is important. But however, in my view, regional imbalances are not mainly due to productivity problems, but due to the overall unequal growth of the London Greater region versus other UK regions. So in this respect, I was wondering if there are integrated programs at the moment being introduced for reducing spatial imbalances in the UK. Thank you.
Thanks both. So Arnab, how are we going to solve the conundrum of raising real wages for lower income households? And the second question on leveling up, how do we actually do it?
So in principle, so this is something that we have given some thought to. In principle, I think that what we should be doing as a society, as economy, is create better jobs which would then garner higher wages to pull the bottom of the distribution up. So that's easier said than done, though. So how do we get there is the question. So I think so. If that could be done, of course the margins would also be improved, and it would translate into that. No, so how that could be done is one question, but secondly also it is acknowledging that given the huge disparities that exist within society, this is not going to be a short-term thing. It is going to take the very, very long run, which is something which is well understood. So in the leveling up discourses in the UK 2070s commissions or 2070s commission directly, you can see that there's a 50-year time horizon attached to it, right? So so it's not going to be overnight, but that is what we are needing to do. So to offer both forms the ability to provide higher wages, because the jobs that people do are slightly better than what they're doing now, maybe much better. They are and greener as well. So that is the thing. So coming on to the second question as well, relating to this, so productivity growth. So can the leveling up funds be used to do that, to level up across the country by doing better skills and jobs mismatches across the country, by creating the opportunity for more better work across the country? Yes, it can. So the allocations have been somewhat haphazard, maybe not as evidence-based as would have liked, but what we are doing is then looking at these and so if you see what I mean. So to try and find out what are the spatial direct and indirect effects. So the direct effects being on the place where the investment is placed, and how much of effect it would have in what kind of time frame, and the indirect effects are on other places through spillover benefits and costs. So that is something that we are tracking at the moment, but there's a lot to be done here, and if so one should have further discussions about this as well. So we welcome your comments, but also maybe come back to us so that we can perhaps think about these things better. I think there is a substantial space for and scope for further work, much more work there.
Also, if I could just chip in a little bit on Lewis's question, which I thought was a very good question. So just to sort of give a little bit of context, the corporate profit income share is only dealing with the income generated in the incorporated sector, not the self-employed sector. So proprietors are not included in that measure. However, as we know, about 15% of the UK workforce is self-employed, and they are overwhelmingly distributed at the bottom of the income distribution. Their earnings are much lower than employees are on average. So this could explain some of this discrepancy here in this situation, I think, just because self-employed people are overwhelmingly concentrated towards the bottom few deciles. Thank you.
Okay, thanks everyone. Unfortunately, we're now over time, but we will endeavour to respond to all of the questions that we've received in the chat. And if anyone in the audience has any further questions, then we'd be more than happy to respond to them. If you can just send us an email or get in touch with us, we're always happy to respond to questions. I'd like to thank again the presenters, Barry Naisbitt, Ben Caswell, and Arnab Bhattacharjee. And thank you, the audience, for being here today. And we look forward to seeing you all again in 3 months' time. Thank you very much. Bye-bye.